Good afternoon and good morning, everyone. My name is David Gellis. I'm a business reporter here at the New York Times and the corner office columnist. As part of our coverage of this crisis, we're trying out some new formats these days, and I want to thank you for joining us on this call. This is the latest in a series of live conversations with business leaders about how they are confronting the challenges facing their organizations during these unusual times. Today, we're grateful to be joined by Penny Pennington, managing partner of Edward Jones, an investment firm based in St. Louis, and Keith Mestrich, president and CEO of Amalgamated Bank, a union-owned bank based in New York. By hearing from Penny and Keith today, my hope is that we'll get a clear sense of how the coronavirus crisis is impacting the financial industry, from lending and spending to the markets and investing. A quick housekeeping note before we begin. You may submit questions at any time during this event using the Q&A feature in Zoom. We'll get to them in about 20 minutes or so. Please note this event is being recorded and this is an audio-only event. So let's get into it. Keith, thank you so much for being here with us.
Thanks, David.
So the potential impacts of this crisis were readily apparent to you a bit earlier than they were to many people in the United States. Can you tell us about where you were in February when it became clear that this was going to have a big impact, not only for all of us, but for Amalgamated as well?
Thanks for your question, David. Yeah, I was actually traveling at a meeting of global bankers in Switzerland in mid-February and was watching the early days of the coronavirus crisis roll out in Milan and in the Lombardy region of Italy, and sort of saw some of my colleagues from Italy trying to begin to grapple with it and deal with it. And ironically, I was actually supposed to travel from Bern to Rome to attend a convening that I had been invited to there. In probably one of the better decisions I've made in my life, decided not to go to Italy at that time and face the potential crisis, mostly because I was worried that I might not be able to come back. But had a long daytime flight back home from Europe, and really said, wow, we are going to probably face very much the same thing in the United States and potentially in New York City, where our bank is headquartered. And it really gave me a lot of time to think. And immediately after that, although we had been monitoring the pandemic and watching what was happening, I think I would be hard pressed to say that we were completely in preparatory mode, but we got in preparatory mode pretty quick after that. And there's nothing like seeing, the crisis right up in front of your face and then potentially having to deal with it or avoid it to make you get pretty serious about things.
Yeah, and here we are 2 months into it. Penny, thank you so much for being with us as well.
Thank you, David. It's a pleasure.
So Penny, you also, of course, were watching the effects of this, probably initially, largely through the volatility in the markets earlier in the year. Can you talk about that transition from when you're watching the market volatility that was triggered in part by the growing recognition of the scale of this impact, and how that then translated, I suspect, in sort of mid-March, as it did for so many of us, into real impacts on how you were managing your employees at the company?
Yeah, thanks for asking. So the first really in-depth conversation that I had was at a St. Louis Federal Reserve Board meeting, where a couple of the board members have global operations, and we were talking about the effects that they were seeing. And then soon after that, started to see the market volatility. And then right after that, started to feel the local impact, from the perspective of Edward Jones, in that we have a location in 68% of the counties in the United States and all 10 provinces in Canada. And so when Pennsylvania, which was one of the first states to come out with a pretty hard line stay-at-home order, when we felt the effect of that in tandem with what our clients were already feeling with market volatility, it became a 3- and 4-dimensional issue, problem, opportunity in terms of taking care of our clients, taking care of our colleagues, and taking care of the communities, all of those communities where we serve. And just like Keith said, you go through BCP, business continuity planning, as something of a tabletop exercise on a pretty regular basis. I'm glad that we did. Feeling it and experiencing it from the lens of our clients and their investment portfolios and our colleagues in serving those 7 million clients got real personal, real critical, real quick.
Well, I want to come back to the markets, but first let's talk about those frontline workers. You mentioned them, and you, of course, each have branches in addition to all your office workers. Keith, yours is the decidedly smaller footprint, and yet no less important to sort of your brand and identity and the ability for many of your consumers to actually use your services and access your products. Can you talk about what decisions you've made for your branch network in New York, California, and beyond?
First, I just want to really thank our own heroes, who are those frontline workers, the tellers and retail bank representatives and branch managers, and the handful of branches that we still have open. Not only have we had the challenge of grappling with providing a retail business during the course of this, we've had to do it in New York City, and had all the special challenges of being at the epicenter of the coronavirus pandemic to deal with. So we've just had to prioritize first and foremost the health and safety of our frontline workers. Obviously, we care about the safety of our consumers as well, but we have really wanted to make sure that I'm in a city where people are dependent on public transportation to get to and from work, and have to put themselves in harm's way in so many different ways, not only at work, but getting to work and then getting home from work and being with their families, oftentimes in very small living quarters. We have tried to keep the extent of our retail branch operations as thin as possible. So we are down to 2 branches open in New York City. They're only open a couple of days a week. We practice social distancing in the branches. We've actually gone back to hiring guards in some of our New York City branches that help enforce some of that. We've tried to do a lot of outbound calling. So our branch staff who's not working is actually on the telephones reaching out to customers, particularly those in what I kind of call the last mile of our customers who have been slow to adopt digital technology, or maybe have a transaction that needs a live person to do it, and doing outreach to those customers to see if there's a way that they don't have to come to the branch. And we've been able to whittle that down in a way that we can protect both our employees and our customers. So we've spent a lot of time and attention on it, and doing it. And it's hard, but it's really important to put a lot of tender loving care into it.
Penny, you were able to take a different tact. And my understanding is that just about all of your branches across the country are now closed. That's a huge, huge operation, though. Talk about the decision to do that, how you went about it, and what the trade-offs are, as it were. Obviously, plenty of social distancing, but I see they're right there on your site. You're not meeting with new clients right now. I mean, that's going to impact the business at a certain level.
Well, let me be very, very clear. We are not closed. Our branches, we have about 15,000 branches across North America, about 19,000 financial advisors. Our branches are closed to the public. Our clients, we ask not to come into the branch physically about 5-6 weeks ago. And that was a very difficult decision, because the human-centeredness, the relationship is the center of the service and the value that we provide in helping people reach their financial goals. That's a long-term that's a long-term relationship that we're focused on. And so not seeing them face to face was a very big decision. It was a very hard decision, but just as Keith said, it really was focused. It comes from a set of guiding principles: protect the health of our clients, protect the health of our colleagues, take care of the communities where we serve. So our branches are generally 2 to 4 individuals by their very nature. They are safe places because we can get social distancing in the branch. And so our branches and our branch colleagues are, for the most part, still in the branches, though within about 10 days' time, we developed a way through technology that nearly all 47,000 of our Edward Jones colleagues could work flexibly. Our 7,200 home office colleagues are, for the most part, working at home, and our branch colleagues are mostly still in the branch, but each of them, the financial advisor and the client service professional, we call the BOA in the branch, have the ability to work flexibly. Within about 10 days' time, we had about 15,000 remote connections available in our system. We amped that up to 50,000 within about 10 days' time. So we can continue to work flexibly. We are an essential business, and we take that very seriously. We consider that a privilege. We want to ensure that people are safe doing it, but through the combination of our branches, our home office associates, and good technology, we are able to continue to serve our clients and, interestingly, meet new and prospective clients. Keith, I know what you're finding as well is the necessity of online business, of transacting business remotely, has hit all of us at the same time. It used to be kind of a nice to have, wish more people were embracing this, and now it's an absolute necessity.
Penny, some states are opening back up and presumably allowing, of course, you're an essential business, so you could have, perhaps even kept some of those branches open to in-person clients. You made the decision not to. As some of these restrictions loosen, are you planning to be among the first businesses to get people back into your branches, or how are you going to approach this?
We don't intend to be the leaders in terms of opening our branches back up to our clients. And the reason why is that our guiding principles have been, from the very beginning of this, protect the health of our clients, our colleagues in the communities where we serve, and keep them connected. And we've been very successful in keeping them connected remotely through technology. I heard someone say new and true. There were tried and true ways of doing that. Now there are new and true ways of doing that. Since we've been successful in that, we don't feel that it's appropriate to take the risk of being in a leadership position to open our branches back up ahead of what others are doing. Now, we will continue to be guided by our guiding principles, by health officials, by data, and by the feedback of our own colleagues. And those are the principles that will lead us as we move back into this, but we will be very deliberate, very intentional.
And Keith, as companies and leaders like Penny do start that process of getting people back into places where there just haven't been people, can you give them a sense of what they face? You still have a few branches open, so you are getting, a very early glimpse at what life is going to be like on the other side of this for many companies that just haven't had the experience. What is different at those branches that are currently open, and what lessons do you have for other companies that are looking ahead and realizing that day is going to come? Maybe they're not going to be the first to go, but at some point we're going to have people back in offices, back in branches. What are they going to need to do to make sure their customers and employees are safe?
So first of all, the physical environment is going to become a little challenging, and I think people are going to have to grapple with how to continue to make their places of business inviting places to be. Over the last decade or so in bank branches, for instance, we took down what used to be called bandit barriers, which were the plexiglass or other barriers that separated tellers, from the customers, really as a way of protecting people from armed robbery. But those went away to create a more human touch, if you will, and more human to human experience, and create a warmer atmosphere in many of our branches. And now those are all back. Not only are they back in bank branches, they're in grocery stores and, all kinds of other places of business as well. And I think we'll have a challenge on how we make, the physical locations where we operate warm and welcoming to our customers and to our employees who work there. And two, one of the things that we've had to deal with, and just the fear that our employees, have of going to work every day and dealing with that. And it manifests itself in a lot of different ways. Sometimes it's wanting to make sure that the physical location is, cleaned very well every night and that they can feel comfortable coming in and touching surfaces. Sometimes it's making sure that hand sanitizer or PPE is available. Sometimes it's just making sure that people know that if somebody else tests positive or is concerned that they may have been exposed to somebody who's tested positive, does the company actually have a plan to respond to that? And is that well communicated so that people know what's going to happen if there's a situation that has to be dealt with? It's trite, but communicate has been something I've just had to learn, again through this. And we probably are communicating better and more thoroughly and more regularly throughout our institution today. But it is really important for those folks who are on the front line and for our customers too, so that they aren't surprised by things that actually happen. But I think being able to be nimble and deal with those situations is a real thing.
Well, thank you for that. It's going to be a huge challenge for all businesses, from restaurants to banks to investment advisors. Penny, let's talk a bit about the markets. You are already in the business of managing market volatility, but this is a stretch for everyone, I imagine. What's kind of strategies, if you can say anything sort of universal, are your advisors using as they try to navigate these sort of unprecedented times, especially as the markets seem in so many ways disconnected from the real economy? And I hope you can talk to us about that as well. So maybe two questions. One, what are you advising your investment advisors to do as they manage this? And two, can you just help us unpack what seems to be this real disconnect between record unemployment, the real economic carnage, and the markets, which seem to keep going up?
Yeah. Well, what we seek to do for our clients, 7 million clients, is to, I'm just going to say it very simply, is to relieve anxiety. How do we relieve anxiety in good times and bad times? Well, our job is to understand what's most important to our clients and their families, and put together a set of strategies that are tailored to them and their needs, balancing those goals that they have. And sometimes those are complex trade-offs that have to be managed over time. And then we partner with them throughout their lifetimes and the lifetimes of their families, generations of folks that we've served, to help keep them on track to achieve what matters most to them. So in good times and in bad times, notwithstanding what was going on with the market 6 months ago was very sanguine. What's going on with the markets right now is a little uncertain. That job is the guidepost for what we do for our clients. And so we've been setting expectations with them for quite some time that this great market, it has gone on for a while. There are no real cracks in the economy right now that we see to be worried about. But you know what? There is often something lingering out there that can put a hitch into the best made plans. And so when
just to interject, I mean, isn't this the biggest of hitches? I guess I'm surprised to hear you say that you don't see any sort of cracks in the economy. It seems like we've got a chasm that has suddenly appeared.
No, sorry, David. Maybe I communicated that incorrectly. 6 months ago.
Got it. Forgive me.
Ago, the economy, the fundamentals of the economy, corporate earnings, all of those markers of what's happening in our economy were quite stable. But things fly in. Unexpected things are often what destabilize the market. And so as much as we've been preparing clients for something that might destabilize the markets, we had no idea what it was. We prepare them by helping them put in place a tailored plan, allocating their investments wisely, so that in a down market like we've had, the individual investor doesn't have to suffer as much of the down as the S&P or the Dow might show you. Mm-hmm. But then you asked this question about what's really going on in the economy, and is it disconnected from reality? Well, one thing that I think we have to just keep remembering is that the ignition switch for the market volatility that we've seen and will continue to see was not a weak economy. This is not a replay of the financial market downturn that we saw in 08-09. The ignition switch for this was a global pandemic during a period of time when the economy was actually pretty good. So all that we're going to read in the newspapers is we've never seen unemployment numbers like this, for example. Well, that's exactly right. Not in my lifetime have we ever intentionally shut down the economy. So those things would have been expected, and we can't compare them per se to times that we've had before. So you'll read all kinds of things about when are we coming out of this, and when will consumer confidence return, when will the stimulus kick in, quote unquote. Well, it will when consumers are confident enough to go back into the economy and begin to spend money. Remember, 70% of our GDP is consumer spending. Yeah. And consumers spend in stores, online, in restaurants, at entertainment venues, and in healthcare settings. So when that confidence returns and the market seems to be pricing in a return of confidence later on in this year, as things begin to open back up, the economies locally begin to test how, as Keith so well described, how confident they can be in their safety, then that will begin to determine the upswing in the market. We believe that that's going to become more dynamic toward the end of the year. We don't see a V-shaped return in the economy as some have described. It's going to be a bit of a bumpy ride, but that's what the market is pricing in is some return to confidence later in the year.
Okay, well, let's. I'll take it if we can really start getting back to normal later this year. I'll take it happily. Keith, you're probably getting an early glimpse at this. You have residential mortgages, you have consumer loans. Can you talk about what kind of impact you're seeing to the ability of some of your customers to make those payments and what kind of capital needs they are already having, perhaps on the commercial side? Yeah, I suspect this is sort of a snapshot of where we are as an economy right now. What are you seeing?
Well, we've had 30 million people apply for unemployment in 5 or 6 weeks. Obviously, what you're starting to see is people having to make choices with the limited number of dollars that they have, and they have to make choices about paying for food and medicine or paying their rent or making their mortgage payment. I've been pretty happy so far in the sense that while we certainly have seen requests for some relief from our consumer customers in terms of their mortgage payment, for instance, it hasn't been overwhelming. I think people in the early days of this have been able to figure out how to meet some of their obligations. But May payments are due now, and we're starting to see some inquiries again. And I think when June comes, we'll start to see a lot more of it. But we've lived in an economy here for a long time now where tens of millions of Americans, really can't sustain themselves, beyond living a paycheck to paycheck existence. And it's a real problem that our economy has faced for some time. And we're seeing, the real impacts of that right now when people face unbelievable pressure. I do think the government did a good job of getting stimulus payments to people quickly, which has probably stemmed some of the most dire and drastic things that have happening. But Penny said it. We don't know how long this the disease phase of this is going to last. We don't know how deep the economic carnage that could happen from this will actually be. We don't know how much stimulus there will continue to be or how effective it will be. And it's hard for businesses to make plans around that. And it's even harder for, I think, individual people to make plans around that. And people are grappling with that now. And there's a pretty big and growing cry for help. Maybe the thing that illustrated it more than anything was the demand for loans under this Paycheck Protection Program Act that happened. I mean, lots of small businesses really just represent the paycheck for a lot of people. I mean, the income and revenue that comes from that small business is the equivalent David or Penny, you know, the three of us getting a paycheck every week.
That's right.
That's their paycheck, and those dried up, and we're not even a small business lender, and yet we saw tremendous inquiries of people looking for help, and and the whole country saw it, and it completely overwhelmed the system, and maybe more than anything else, that illustrates the pain that people are feeling in the country. And the calls I had with people that wanted to gain access to that program, they were unlike calls that I had ever encountered before. They were calls from people who were very afraid and very concerned and very uncertain about what would happen next, and really just tinged with people struggling for their own and wondering about what their survival would look like. And we're going to need more programs like that, because I completely agree with Penny. We're not going to see a V-shaped recovery here. It's going to take longer than that. And we're going to need, as private businesses and public entities, to figure out how to help people.
No doubt about it. We've got a bunch of questions from the audience lined up here. And just as a reminder, we won't be able to get to all of them, but if you have a pressing one and you're listening in, thank you so much. Please use the Q&A function on Zoom to add one, and we'll see if we can get to it. Before we do that, I have one last one, and this actually came out of something Keith and I were talking about briefly yesterday. And Penny, I'm going to put it to you first. You know, it's one thing to get through this, but you used a word earlier that caught my attention, Penny, which was opportunity. And I wonder, how do you think about growth in the middle of all of this? You know, we're all trying to get by, but of course your job at the end of the day, at the end of your tenure as managing partner, is certainly at some level going to be measured by the degree to which you were able to grow this business. How do you think even about looking for new opportunities in the middle of all this?
Yeah. Well, I call growth and impact. Growth can be counted in a lot of different ways. The numbers of financial advisors that we have, the numbers of communities that we serve, the numbers of dollars that our clients privilege us with taking care of. But it's about growth and impact. And what I believe the opportunity is coming out of this is that people are reassessing their lives. They're reassessing their livelihoods. They're reassessing relationship and what it is that matters most to them. And the organizations that are there to not think just about them, but think like them at a moment that their thoughts and their value systems, and in our world, their risk tolerances may be changing dramatically, that we are there for them, part of their family as they go through this. I'm going to say unrelentingly optimistic about the way that we can not just survive, but thrive together and help them, their families, and their communities. I believe that is where impact is grown. I believe that's where brand and reputation is grown. And I believe that is what will make organizations distinctive, not just in our business, but as they have been seen to be helpful to people, to reassess the value that they're delivering. We have delivered new kinds of advice and information about the CARES Act, about physical and emotional well-being, in addition to financial well-being. We have entered into conversations with our clients that during more sanguine times, we might have to have a years-long relationship to enter into. And today, that's on the forefront of people's minds, is what they value and how they value their futures. I think that's where growth and impact is going to come.
That's very good. And Keith, just very briefly, you are again just trying to keep the wheels on. Are you able to think about growth and opportunity at a moment like this, or are you still really head down, just making sure your clients are getting the service they need at this moment?
Been thinking a lot about that in the last couple of weeks, and the reality is we don't know how long we'll be in this. Our company and companies across the country have done a great job of showing resiliency and being able to continue their day-to-day operations with a highly distributed workforce. And we'll be able to do that for some period of time. But if we're going to be a vibrant business, we've got to figure out how, in the short to medium term, we use the new technologies and the ability to think about innovation and growth, and new customer acquisition and new customer relationships, in ways that we know how to do it the old way, which is pressing the flesh and spending time with people. We'll be able to do that again at some point, but we're going to have to figure it out. We're going to have to figure it out in the new world here.
Yeah. Okay, let's get to audience questions. First one, I'm going to kick right back to you, Keith, and it's from Christopher, who asks, what's the outlook for residential real estate for the next year and beyond? And I have to believe that, though that isn't your primary business, you've got a beat on this, given your exposure to mortgages and the consumers who are your customers.
Yeah, we continue. It is a big part of our business. We see it's really hard to tell. Some of the early numbers that came out actually showed very little decline in demand. That demand has actually held steady in the early stages of the pandemic. I doubt that will last. I think as the impact from the economy deepens and goes on for some period of time. And I think as the pipeline, if you will, of outstanding contracts that have to get across the finish line, dry up a little bit, I think you'll start to see decreases in demand. And of course, it's not going to hit all parts of the country the same way. It didn't after the 2008 financial crisis. Some markets did well. Others really suffered. What will happen in highly dense urban environments where people may not want to live in those places anymore? Will people choose to spread out, more into rural areas and other things? Economic impact, people's own fear of living in densely packed environments, it will change the nature of the residential market. I think it will start to decline, and then I think it will be different, just like so many parts of our economy will.
Yeah, well, thank you, Keith. Next one, I'm going to send Penny's way. Penny, Claire asks, and this is timely given it's about Warren Buffett, who, of course, was not able to do his annual gathering over the last week and did it online instead. And Claire asks, Warren Buffett said Berkshire Hathaway hasn't made any big investments recently because they didn't, quote, see anything that attractive. She asked, should we all be staying away from the stock market if even Warren Buffett can't find good investments right now?
So the Buffett impact, right? Do what Warren does.
It's worked out for him and Charlie, I'll tell you that.
Yeah. In long-term investing, and that's what we're about. We are not looking for the thing that's going to do well tomorrow, and neither is Warren Buffett. He said that his holding period is forever. So, I don't know exactly where his investment thesis is right now, but ours would be invest in high quality companies and investments. Recognize that there are going to be industries that at least temporarily are going to be really challenged, but oftentimes strong companies in industries that are challenged, if you have a long holding period, this is exactly the time to be making those kinds of investments. Do it smartly and do it in ways that you are well diversified. Don't try to bet on what's going to go on tomorrow or next week or 2 months from now.
We've got a series of questions here, and it gets back to the branches for both of you. And both of you talked eloquently about why human-to-human interaction is so important and why it's very important to have a warm and welcoming space where customers can come in, interact with the brand. But I think for so many people, this is really making us question some assumptions about that. And so Warren asks, why even bother to reopen the brick and mortar financial offices if everything can really be done by the customer online or virtually? And then more broadly, I think there's a question of how this pandemic is forcing conversations in your respective institutions about the role increased technology will play in the short and long term. And that's from Adam. So Keith, why don't you first take the branches issue, especially because your branch network is relatively small. Are they really needed? And can you not replace some of that and perhaps save some costs with technology?
It's a great question, and I think it's a question that not just banks, but everybody who runs retail establishments is going to be asking themselves. And I think we'll see, a very strong change in the real estate markets that happens because of it. But there's a second question that goes with it, and it's one that we've been asking: is what actually does happen in the branch, and what's the experience in the branch? And do we change those into highly interactive kind of places where we can engage our customers, not just on the traditional transactional activity that's happened in the branch, but where do we really engage them on all aspects of their financial lives? And how do we become an important and integral part of the community that makes up our customer base, so that we have engagement centers where we can really do that? And I still think we will go back and continue to have that conversation and do that. And then on technology, there's a whole bunch of questions that come out of technology on this. There's all kinds of questions about, do you have a resilient network, and are you able to switch it on and off when various crises come up? Do you have the ability, almost on a dime, to be able to move your entire workforce into a different kind of working environment? What does customer experience really mean? And what are the kinds of questions we have to be asking ourselves as we think about the things that customers really need to do online? And have we fully anticipated all of their needs to do that? It's a tremendous opportunity to get rid of paper and move to a completely digital and electronic transmission of documents and a number of other things. I know as a customer of other companies that I'm going to be talking to some of our vendors and providers about things that we need. So this is a transformational moment, I think, in many, many ways.
Yeah. Penny, how are you thinking about the branches issues specifically, and whether you really need as many or even any, which would be pretty radical, and then more broadly about where technology is going to be even more important when we get to the other side of this?
Yeah, well, I agree with everything that Keith just said, and what I'll add on to it then, and I know it's true, and Keith, in your business, is what we're really talking about is how to build a trusted relationship. And trusted relationships, people feel differently about in terms of what they trust, who they trust, what sorts of engagements they trust. And very traditionally, trust has been built through human being to human being interaction. Those old adages about looking someone in the eye and shaking someone's hand. And interestingly, all of that has been cut off for us right now. And I think we're feeling it. I think what's being dialed up is that kind of professional intimacy is actually quite important to people. We've talked about it as the difference between human-centeredness and machine-based. And there are certain things that human beings do with and for each other that come from human love, really. The root of it is love. We don't believe that machines can do all of that. However, we do know that individuals who want to build a trusted relationship want to be able to engage on their own terms. And sometimes that means I need to be face to face. I need to be in the same airspace of someone. And other times, my iPad sitting in front of me that I can work on at 11 o'clock at night and be in communication with a brand, a person, an organization that I trust, that engenders a lot of confidence in me as well. So I don't think it's one or the other. I think it's a yes and hurry up is what we're going to be faced with tomorrow.
Yeah. This one's going to be pertinent to both of you, and it touches on just about everything we've covered at some level. It's from a listener named Bob, and he asks, can you please talk a bit more about consumer confidence, and in particular, consumer spending? Penny, you said it earlier, spending money is sort of what we do as a culture. It's how we organize our interests, our hobbies. It's sort of an essential part, not only of our economy, but our identities. And yet there is so much economic contraction happening right now, and so much fear. I think someone used that word earlier. I wonder what each of you think about the near and medium term prospects when it comes to a return to previous levels of consumer spending. Are people just going to really rush back out and start buying all the things they used to buy? Or is there not going to be a certain amount of cautiousness and as a result, an increased levels of savings? Keith, why don't you take that first? What are you seeing already, and where do you think this is headed?
going to use my own spending patterns, and just looking at my own American Express statement a little bit earlier today, and the very small number of things that I've spent money on in the last 8 weeks. And then you think about the discretionary spending I did do, and those are going to be hard things to get back to doing, whether it's buying concert tickets or going to the ball game or going to the kinds of, or traveling or doing those things. I think you're going to see a fairly substantial curtailment of activity in those areas until people really feel comfortable going back and being in large crowds. And while you might see a quick flurry of people rushing back into stores and other things, I do tend to think we'll see a decline in consumer demand for some period of time. There'll be a backlog where people have to get things and do things and get haircuts and get their nails done and do the things that they need to do. But a lot of other parts of the economy, it's going to be a long time before we see a recovery.
And Penny, you may be seeing this already. Some people have continued to earn at pre-crisis levels, but they aren't spending it as much. Are they investing more? Are they saving more?
Actually, they are, yes. Taking advantage of down markets right now. The percentage of buy transactions that we see for high quality investments is higher than the percentage of sells. So yes, people are taking advantage of that. And while the consumer makes up 70% of our economy, I for one hope that there is a little bit of a reset in terms of saving emergency cash, ensuring that you and your family are protected in all kinds of different ways. Keith said it, there's a high percentage of folks in our country who can't come up with $400 or $1,000 in an emergency, who are living paycheck to paycheck, and ways that more families in the United States take a look at their long-term well-being and are able to devise ways to spend less, to save a little bit more. I think that would be a very good thing.
Mm-hmm, mm-hmm. Lastly, this comes from a listener named Scott, and it really gets to what the future looks like. And listen, I think we all by now can admit that no one knows quite what's going to happen next week, let alone next quarter or at the end of the year. And yet, as leaders of your respective institutions, you have to do your best. So Scott asks, what's the economy's liquidity risk if a second wave comes back bigger than the first? And is there a way to mitigate it now? But I think that gets to this broader issue of how each of you are positioning your companies for a very uncertain future, with the distinct possibility, as history has told us, that there could be a second and potentially even a third wave to come. What do you do now to make sure that you're ready for this? And more broadly, to Scott's question, is there a liquidity risk if this really continues to roil us for 6, 18 months more?
I'll go first there, David. We have taken steps to tighten up our risk bucket and what kinds of companies and entities and projects that we will lend to. And I think we will continue to do that to make sure that we are in a position of preserving our precious capital, so that if there is an extended downturn, we can rely on ourselves and not other entities to be able to support ourselves in any type of crisis. And I think we'll continue to do more and more of that. We want to help our customers, and we will obviously put that forward, but we will tighten things up, and we'll be judicious in the decisions that we make to make sure that our company, which survived, through the 1929 crisis and every crisis since then, can survive through this one as well. And I have been really impressed by the Federal Reserve and really the commitment of the Congress of the United States to do everything that they need to do to make sure that we don't have a liquidity crisis again. And while it might take massive amounts of effort, that crisis from 2008 is not that far in the rearview mirror. And it's pretty clear that central banks and governments around the world have learned the lesson that they have to do whatever it takes to make sure that that doesn't happen. And I hope that commitment remains and continues, because we won't be able to do it from the private sector only. We'll need, the massive support and assistance of our governments to make sure there is no liquidity crisis if we have, a second and God forbid a third wave of the pandemic.
Thank you, Keith. Penny, just briefly, how are you positioning for the possibility, especially as you think about balancing portfolios and rebalancing, given all the new information of potential further waves to come?
I think I'll just follow on with what Keith shared and say that this is highlighting for us that leadership really matters. Leadership of our organizations to make aggressive, decisive, but long-term oriented decisions about the sustainability of our firms so that we're here to help our clients. For us, helping our clients, think about uncertainty, prepare for and manage the anxiety of that by having long-term oriented plans. And then, just as Keith was saying, we can't all do this all by ourselves. Recognize that as families, as businesses, as government, as community leaders, we do have the opportunity to think about the future that we want for our country, for our families, and make different kinds of decisions. Make decisions based on understanding that really frightening and uncertain things can happen, and that we can be better prepared for them as they continue.
Well, thank you, Penny. And thank you to all of us for joining us on today's call. Special thanks, of course, again to Keith and Penny. And to find out more about our full slate of digital events, including the next installment of Corner Office Live, please visit timesevents.nytimes.com. And please subscribe to the New York Times. It's the support of listeners and readers like you that makes our reporting possible. Keith and Penny, thank you again. And we look forward to speaking with all of you again soon.
Thanks, David.
Thank you, David. Thank you, Keith.
Thanks, Penny.
Thanks, everyone.
Nice to meet you, Keith. Thanks for